How does state corporate tax work? Have you ever wondered how state corporate taxes actually function? Understanding this can help clarify how businesses operate within different states. State corporate tax is a tax imposed by state governments on the profits of corporations that operate in their areas. This tax is in addition to the federal corporate income tax, which is currently set at a flat rate of 21%. From a conservative viewpoint, state corporate taxes serve as a means for state governments to generate revenue while also influencing business decisions and economic growth. The corporate income tax is calculated by taking the net income of a corporation and subtracting allowable deductions from the gross income. This tax primarily affects C corporations, which face taxation at both the corporate level and again at the shareholder level when dividends are distributed. Different states have different types of corporate taxes. Some states impose corporate income taxes based on net income, while others may use gross receipts taxes. Gross receipts taxes are levied on total sales without considering any business expenses, which can be more burdensome for companies. When it comes to tax rates, there is a wide range across the states. For example, North Carolina has a low flat rate of 2.25%, while Minnesota has a higher top marginal rate of 9.8%. Most states have a single corporate tax rate, but some may have graduated rates based on income levels. Kansas is an example of a state with a statutory rate that includes a surtax for income exceeding a certain threshold. From a conservative perspective, lower state corporate tax rates can stimulate economic growth by attracting businesses and reducing operational costs. This aligns with the principles of limited government and free markets, as lower taxes can lead to increased investment and job creation. States with lower corporate tax rates are often seen as more competitive, which can lead to greater economic activity. Complex tax systems can drive businesses to engage in tax planning strategies to minimize their tax liabilities. Simplified systems, such as those with single rates, can help reduce this incentive. It is also important to note that many businesses are structured as pass-through entities, like S corporations, which are not subject to corporate income tax. Instead, their income is taxed at the individual shareholder level. Conservatives generally advocate for lower corporate tax rates as a way to encourage economic growth and minimize government interference in the economy. High taxes can deter investment and lead to higher unemployment rates. The reduction of corporate tax rates in states like Iowa and Kansas reflects this philosophy, aiming to create a more favorable business environment. However, the effectiveness of these policies can vary based on the specific economic conditions of each state.